How does a trust affect my income taxes? Have you ever wondered how a trust can influence your income taxes? Understanding this can be a game changer for your estate planning. Let's break it down in simple terms. The way a trust affects your income taxes largely depends on the type of trust you have. There are two main categories: grantor trusts and non-grantor trusts. In a grantor trust, the person who creates the trust, known as the grantor, retains control over the assets. This means the income generated by the trust is reported on the grantor's personal income tax return. The trust itself does not pay taxes. For example, if you have a revocable trust, it is treated as a grantor trust during your lifetime. All income, such as interest or dividends, is reported by you, and no separate tax return is needed for the trust. On the other hand, non-grantor trusts are separate tax entities. They have their own tax identification numbers and must file their own income tax returns using Form 1041. Any income that the trust retains is taxed at the trust level. If the trust distributes income to beneficiaries, that income is reported on Schedule K-1 and taxed on the beneficiaries' individual returns. Now let's talk about irrevocable trusts. Once you create an irrevocable trust, you give up control over the assets. These trusts usually have their own tax identification numbers and file separate tax returns. The trust pays taxes on any income it retains. However, if the grantor retains certain powers, it may still be treated as a grantor trust, meaning the grantor is responsible for the taxes. Income generated by the trust, such as interest, dividends, and capital gains, is subject to federal income tax. Trusts are taxed at compressed tax brackets, which means they reach the highest tax rates at lower income levels compared to individuals. This can lead to higher taxes on income that the trust retains. State income tax is another consideration. Trusts may be subject to state income tax based on where the trustee lives, where the beneficiaries resided, and where the trust assets are located. For instance, in California, trusts pay state income tax on earnings, and the residency of the trustee can influence tax obligations. Trusts can also deduct certain expenses related to managing the trust. This includes trustee fees, investment advisory fees, and tax preparation costs. These deductions can help reduce the taxable income of the trust, whether it is taxed to the trust itself or passed through to the grantor. Understanding how a trust affects your income taxes is essential for effective estate planning. By knowing whether your trust is a grantor or non-grantor trust, and whether it is revocable or irrevocable, you can better prepare for tax implications. Proper funding of the trust and awareness of tax obligations can help you avoid unexpected tax consequences.